Hello everybody, Luke Gromen, FFTT. Hope everybody is well and safe this weekend. It's been a great weekend here. A lot of baseball, arms a little sore, threw about 180 pitches of batting practice with a couple different high school baseball players yesterday. Ended up going out with my son today because it's a nice day and it's that time of year, so threw about another 80 or 100 pitches today. So going to get cryoed up tomorrow. I'll be ready to go. So let's jump right in here into the questions. Got a bunch of good ones. Going to try to cover as many as we can. So first off, from KS, in light of the current unrest in the U.S., do you see another round of stimulus checks to the people, extended unemployment benefits, eviction freeze, etc., that kind of things, for fear of a second round of unrest when people's money run out over the next couple of months? The short answer is yes. I think all else equal, the U.S. unrest does make another round of stimulus checks more likely than less. I think it's an important point to make because the extended unemployment benefits apparently run out in August. It's something we talked about in Tree Rings this last week. But that's going to be a key thing to watch. The amount of transfer payments from the U.S. government to the U.S. consumer have been, for lack of a better word, enormous. And if that starts to change, it is likely to show up in the economic data in a big hurry, and in particular in the savings rate. So let's watch. The second question from CS. Regarding money creation, do you expect the balance sheets of the Fed and the ECB to show that they are very different paths? The short answer is no, I don't. I think they're both going to be headed higher, and I think over time the Fed's balance sheet is going to have to rise, I think, a lot higher than the ECB's because no one's more short dollars than the U.S. government, and because ultimately the Eurodollar system is the Fed's problem and not the European Central Bank's problem. However, with that said, as many people have noted, path matters. And so while I feel very strongly about the relative size of the Fed's balance sheet likely ending up being much bigger than the ECB's by the time this is all said and done, I don't feel as strongly about the path in the near term. And so for me, that just, as Kirill Sokolov has said, that's why gold is easy. I don't have to get the path right. I just have to assume that both are going to be moving their balance sheets higher, and gold should do well. And so I think that's ultimately how I shake out on that. Third question from Max. You've made a great case to be short the dollar over the medium long term. Can you make a similar case for being long the euro or Europe, aside from the euro weight and the DXY, since everybody and their brother seems convinced that the Europe has one foot in the grave already? Yeah, to me, the medium to long-term bull case on Europe is that the global monetary system is moving back towards a balance of payments-centric system. What that means in plain English, if you look back over the basically most of recorded economic history, currencies traded based on balance of payments fundamentals. In other words, did you sell more than you bought, or did you buy more than you sold? And if you were a net importer, you generally had a weaker currency. Net exporter, generally a stronger one. And then also your pile of reserves, which for most of history were gold. That was the way the world worked, by and large, up until 1971, when the world got turned on its head. And so suddenly, historically, for hundreds, if not thousands of years, the country with the best balance of payments and the biggest pile of reserves had the strongest or best currency. After 1971, the country with the worst balance of payments and the least amount of FX reserves, the United States, had the best currency. And that was just the way that system worked because the dollar was the reserve currency, and there was and the treasury bond was the primary reserve asset. So the bull case in the medium long term on the euro is that as what we're seeing transpire, particularly in energy, but in commodities more broadly, multi-currency pricing of energy and commodities begins to shift the world back to a balance of payments centric system, because global energy, both exporters and importers, don't need to stockpile as many treasuries. And as that's the case, the U.S. deficits suddenly need to be financed, for lack of a better word, increasingly by the Fed rather than other parties. And so over time, a more balance of payment centric system driven by multi-currency energy should start to reorder the big five global currencies, at least, but all currencies more broadly, in a balance of payment-centric fashion. So if we look at the SDR basket, China, Europe, Japan, all significant creditor nations, followed by the pound, which would be a modest deficit nation, and then last in this case is the United States. The U.S. has by far the biggest deficits, and that's twin deficits, current account deficit, and that's why it's not because we're bad. It's just that's how the system worked from 71 up until present, and so to the extent that we are moving away from this dollar monopoly in energy, it shifts the world to a more balanced payment-centric system, and to this extent that happens, and it's happening, to the extent it continues happening, that is all else equal bullish for the euro relative to the dollar. Now, the Europeans 2 years ago, a year and a half ago, Jean-Claude Juncker said we're paying for 80% of our energy in dollars, even though the Americans only supply 2% of it. We should be paying a lot more in euros. It's 300 billion euro a year, so it's a big number that they could save if they buy in euros, and they could take the dollars they're currently spending on energy, deploy them elsewhere, which would also be all else equal, give the euro more breathing room. So long-winded question, or long-winded answer to what I think is a very good question, I should say. But that, I think, is really the medium to longer term bull case on the euro, is just the world continuing to move towards more of a balance of payment-centric system. So let's see here. Next question from PD. Could you expand on your thesis that rising equity prices are a matter of U.S. national security? And has there been any official acknowledgement that management of asset prices is a Fed tool? Sure. So the key here is that if you look at IRS data, net capital gains plus taxable IRA distributions are about 200% of annual growth in personal consumption expenditures, or PCE. And PCE is 2/3 of GDP. So that's not to say people are selling stocks and assets and buying boats and cars and healthcare equipment or healthcare services. PCE is a big category. But what it does mean is that mathematically it's impossible for PCE to grow if stocks are falling. And if PCE is not growing, it's almost impossible for GDP to grow. And if GDP doesn't grow, when you've got a debt to GDP of 120% and rising rapidly like the U.S., you're in a debt spiral. And so that is the math of it. And now importantly, that 200%, that doesn't include stock options or restricted stock. Because that's all taxed ordinary income, which brings you to the second sort of way you can infer this, which is that the 60% of taxes, individual income taxes, are paid by just 5% of U.S. taxpayers. That's 30% of overall taxes paid by just 5% of U.S. taxpayers. The top 5% of U.S. taxpayers are not making their money hourly in cash. They're just not. They're making it in asset price appreciation, stock options, restricted stock. And so again, there's this inference you can see how important stocks are. Now, in terms of what policy, how do we know that the Fed knows that this is an important policy? You can go back to 2015 at the Peterson Institute when Alan Greenspan said most people don't realize how important rising stock prices have become to U.S. federal tax receipts. He said if stocks just stop rising, let alone fall, it will quickly weigh on federal receipts, and that will cause a fiscal problem for the U.S. When you go back to Ben Bernanke, when he was asked about why QE was successful, the first thing out of his mouth, maybe there's the second thing out of his mouth, but first or second thing out of his mouth was, well, stock prices rose. So clearly he was focused on those. And Yellen also talked about rising stock prices as a benefit or an important part of a gauge of successful policy. So I would highlight that in terms of the policy responses. Okay, from RJ, do you think enough damage has been done to the U.S. shale complex, and will it lead to higher oil imports by the U.S. and consequently a lower dollar? It's tough to tell at this point. My sense is that oil prices haven't been low enough for long enough, but the longer it goes, as many of you know, the more the treadmill, the depletion rate, where as of a couple months ago, the depletion rate in U.S. shale, the big four basins, was a little over 6% per month. And so once you stop growing production, that depletion rate begins to bite very, very rapidly. And so the longer these shutdowns occur, the longer production is laid down, the more likely it is that we will either go a long time until we surpass prior peak, or we never surpass prior peak again. Your point on the dollar, I think, is a very critical one. We've seen the bull case of the dollar, that we're producing all this oil, we're starting to export it, and that's a net withdrawal of dollars out of the system. We're not seeing a lot of people talk about yet, other than ourselves, the risk that if U.S. oil exports or U.S. oil production begins to fall, exports begin to fall, imports begin to rise at some point, dollar exports will begin rising again. That would all else equal not be good for the dollar, particularly if we're moving back towards a system where suddenly oil is not just priced in dollars like it was for the past 50 years, but also euro, yuan, which suddenly all else equal would add to the way in which it is not positive for the dollar if our oil imports start to rise again. And then the final question here is from DC. The Huawei situation deepening. South Korea has told the U.S. that restrictions on semiconductor sales to Huawei are, quote, unacceptable. I thought this was a really interesting point because we had heard in the last couple of years that a senior exec at a major Korean technology manufacturer company told a good relationship of mine that if forced to pick between the United States and China, that this Korean tech company would pick China, not the U.S. And so at the time when I was told this, I found that very surprising. And now, that question was posed at a different time. It was more hypothetical when it was posed. Now it's looking a lot less hypothetical and more actual. And so let's see what happens. My overriding take, at least at least as of a year or two ago, 12 to 18 months ago, the world's decisions, some key manufacturers' decisions of China versus the U.S., who are we going to side with, may not be as clear-cut as some narratives here in the U.S. would have us believe. So maybe COVID's changed that, but let's keep an eye on it going forward. So with that, I'm going to jump off for the night. I appreciate all of you joining me. Everybody stay safe out there. Stay healthy. If you like these updates, please check out FFTT Tree Rings. It's a Friday piece we put out every Friday. It ends up being a lot of times 15, 20 pages, 10 most interesting things that we have seen, and tries to kind of piece these things together with other data points to make them in, really good roadmaps of where road signs of where we may be and where we could go from here. So, like I said, FFTT-LLC.com for more information about that. Otherwise, everybody have a great week, and we'll talk with you soon. Take care, everybody.